Hello, welcome to Trend News Screens. Today, we will discuss a critical development that has created waves in global markets. President Trump's sudden customs duty announcements in the last 2 weeks have seriously affected not only the trade balance, but also the stability of the U.S. Treasury markets. While the stock market fell, the unexpected rise in long-term bond yields created an economic earthquake effect in financial circles. Between China's possible interventions, the Federal Reserve's moves, and the complex games of hedge funds, investors are looking for their direction. So, what does this chaos mean? Where is the global financial system headed? With the Trend News difference, we have investigated all the details and behind the scenes for you. Now, let's analyze this shocking picture together. In the midst of the sudden changes in President Trump's customs duty announcements in the last 2 weeks, something unusual is happening in a market that is critically important and huge for U.S. Treasuries. When Trump announced his comprehensive customs duty plans on April 2nd, investors quickly concluded that these huge new taxes could lead to a recession. The stock market fell, and Treasury yields fell, as you might expect, a traditional response to a potential downturn. But then, earlier this week, even as the stock market remained weak, something changed. Yields on longer-term treasuries, 10 and 30-year, rose, even surpassing pre-tariff levels. That looked scary. Was a big holder of treasuries, China, quickly becoming the obvious suspect, selling them? Many have worried for years that the Chinese could turn more than $700 billion in debt into a weapon of economic warfare. While anything is possible in opaque global markets, I find this to be a less likely solution. First, some experts believe that China tends to hold much shorter-term treasuries. More likely, what's happening to treasuries is an example of the strange behavior that can occur in times of financial and economic stress. In this case, one possible, but by no means certain explanation is that, following the tariff announcement earlier this month, the market quickly increased the number of Federal Reserve interest rate cuts expected this year from 3 to 4. That has shifted rates up and down the yield curve, the maturity range of treasuries, from very short to 30 years. Hedge funds and other intermediaries often engage in very complex forms of arbitrage, betting on small differences between the price of one treasury and another. Because the differences are so small, a great deal of leverage is often used. Investors may try to quickly reverse these trades when there is a repricing or fear of a repricing, which can lead to unusual and gradual price movements. If things get bad enough, the Federal Reserve could step in to provide liquidity, as it did in the early days of COVID in March 2020. Or the Treasury market could return to normal on its own. And of course, there is always the possibility that this time will be different. Today on Trend News Screens, we discussed an important development that takes the pulse of the global economy together. We saw that markets are shaped not only by numbers, but also by decisions, discourses, and expectations. President Trump's statements, China's possible moves, and investor psychology can change the economic picture at any time. What is happening shows us once again that accurate information, common sense analysis, and a broad perspective are more valuable than ever. We will continue to follow the developments. We hope to see you again in our new videos. Don't forget to subscribe to our channel, like the video, and share your comments with us. Stay on Trend News. Be one step ahead of the agenda.